With SoFi Technologies changing hands around the $17.90 level, retail sentiment boards and financial media networks remain locked in a superficial tug-of-war over headline volatility, completely blind to the profound structural shift occurring beneath the hood of America's premier digital financial services platform. Standard financial coverage treats SoFi like a glorified digital storefront for personal loans, a cyclical lending vehicle vulnerable to the whims of the Federal Reserve and consumer credit spreads. Yet this legacy framing misses the entire physics of modern digital banking infrastructure. SoFi is executing a systemic displacement of brick-and-mortar financial institutions by collapsing the entire consumer balance sheet into a single, high-engagement mobile operating system. While automated trading algorithms trigger sell-offs based on short-term macroeconomic rate jitters and headline-driven price targets from legacy Wall Street desks, they overlook the compounding moat of a technology stack that scales with virtually zero marginal cost. The market continues to misprice SoFi because traditional valuation models are built for 19th-century banking conglomerates, not software-driven financial platforms that compound membership growth while accelerating unit economics. When a company posts record quarterly revenues exceeding $1.2 billion alongside a 40% year-over-year surge, yet sees its valuation compressed by short-termists obsessing over quarterly guidance adjustments, a classic market disconnect emerges. Retail investors surfing social finance feeds are caught between exuberant long-term conviction and panic-induced shaking, while institutional desks quietly accumulate shares during engineered pullbacks. The hidden reality is that SoFi has decoupled its growth engine from traditional branch overhead, substituting high-rent real estate with a proprietary technology platform that captures the modern consumer from their first student loan refinance all the way to mortgages, wealth management, and automated investing. Daily trading volumes in SoFi reflect a ferocious tug-of-war between institutional capital allocators and momentum-driven retail participants. Whenever macroeconomic data releases trigger a wave of rate cut anxiety or slight adjustments to full-year bottom-line guidance, automated programs dump shares indiscriminately, creating sharp downward wicks that systematically shake out leveraged retail traders. Yet looking past the day-to-day tape reveals steady accumulation by sophisticated institutional heavyweights who recognize the asymmetric risk-reward profile of a business delivering consecutive quarters of expanding profitability and record loan originations. Wall Street analyst opinions remain sharply fractured, with legacy institutions maintaining conservative price targets or skeptical underperform ratings, rooted in the outdated belief that digital lenders inevitably face catastrophic credit deterioration during economic slowdowns. Conversely, growth-oriented analysts recognize that SoFi's high credit score demographic, boasting average FICO scores well above industry norms, acts as an insulated bunker against systemic default risks. As the company continues to demonstrate operating leverage where each incremental dollar of revenue flows down to the bottom line at an accelerating rate, the divergence between institutional skepticism and operational reality widens. How are you positioning your portfolio around these volatile swings? Are you accumulating shares during these macro-driven pullbacks or waiting for a confirmed breakout above resistance? To understand where SoFi is heading, one must discard the outdated historical framing that categorizes the company as a mere student loan refinancing startup from the early 2010s. Back then, the business relied heavily on warehouse lines of credit and high funding costs, operating at the mercy of external capital markets. Today, that narrative has entirely been rewritten through the acquisition of its national bank charter, transforming SoFi into a self-funding powerhouse. The modern business model operates across three distinct, highly synergistic pillars: the lending segment, the financial services productivity loop, and the enterprise-facing technology platform segment anchored by Galileo and Technisys. The lending segment acts as the cash flow engine, driving record originations across personal loans, student loans, and home mortgages even through periods of macro uncertainty. Simultaneously, the financial services segment explodes with consumer adoption, fueled by high-yield cash accounts, checking and savings products, and automated investing tools that pull in millions of new members. Crucially, the bank charter allows SoFi to fund its loan book with low-cost, sticky consumer deposits rather than expensive wholesale borrowing, drastically expanding net interest margins. Beneath consumer-facing apps lies the enterprise software backbone, Galileo and Technisys, which provides payment processing and core banking infrastructure to other fintechs and traditional banks globally. This B2B SaaS layer creates a dual-engine model, where SoFi not only disrupts consumer banking directly, but also powers the very infrastructure upon which its competitors attempt to build. Looking toward the horizon, SoFi's multi-year growth catalysts are anchored by secular tailwinds in digital-first banking migration and the inevitable cross-buying of financial products by an expanding member base that is already scaled past 15 million users. As unaided brand awareness climbs into double digits, customer acquisition costs drop precipitously, allowing marketing expenditures to yield higher margin returns. Furthermore, the continued scaling of the technology platform segment promises to diversify revenue streams away from pure lending cycles, introducing high-margin SaaS revenue that commands a premium valuation multiple from the market. Capital expenditure cycles among mega-cap tech spenders and broader fintech adoption trends further support the long-term expansion of cloud-native banking infrastructure. Naturally, risks remain: unexpected shifts in macroeconomic interest rate trajectories, regulatory headwinds surrounding capital reserve requirements, and execution risks in scaling B2B tech volumes can create temporary headwinds. Yet these cyclical friction points pale in comparison to the structural transformation taking place. Management's relentless focus on expanding EBITDA margins and driving GAAP net income profitability ensures that the business is built to compound intrinsic value across diverse economic climates. Investors who anchor their theses to short-term price noise miss the forest for the trees. SoFi is methodically constructing the definitive financial super app of the 21st century, cementing its status as an indispensable gatekeeper of modern consumer capital. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Thank you. Don't forget to like, comment, and share this video to support the channel.